All right, let's dive into this Kewal Kiran Clothing Limited earnings report. It looks like they've had a pretty interesting quarter. Where should we start?
Well, Kewal Kiran, as we know, is a pretty established player in the Indian fashion scene. They've been around for over 4 decades, focusing on menswear, women's wear, and kids wear through brands like Killer, Integrity, and Lawman. It seems they're aiming to be a comprehensive lifestyle brand.
Right, I see that. So, what about the numbers? What are the key highlights from this Q3 and 9M FY25 report?
Okay, so the results release says that their Q3 revenue jumped by 27.5% year on year, hitting 255.2 crore rupees. EBITDA also increased by 20.8% to 46.9 crore rupees. For the 9-month period, revenue grew by 11.5% to 714.6 crore rupees, and EBITDA saw a smaller increase of 2.8% to 138.5 crore rupees.
So that sounds pretty good, especially the Q3 revenue growth. But I noticed the PAT or profit after tax actually declined in Q3. Why is that?
Good catch, yes. The PAT for Q3 actually dropped by 21.5% to 26.1 crore rupees, and the PAT margin contracted to 10.2% compared to 15.9% last year. The release doesn't explicitly state the reason, but we can infer it's likely due to increased expenses or some other factors affecting profitability.
Okay, that makes sense. And for the 9-month period, PAT only grew by 2.0%. So it seems like profitability is a bit of a concern, even though revenue is up. What about their expenses?
Well, digging into the investor presentation, we can see a more detailed breakdown. For Q3, COGS or cost of goods sold increased, as did employee, administrative, and selling and distribution expenses. It seems the cost of doing business went up, eating into their profits a bit.
Yeah, I'm seeing that COGS is up from 113.5 crore rupees to 149.5 crore rupees for Q3. Employee expenses also jumped from 26.4 crore rupees to 36.6 crore rupees. That's quite a hike.
Exactly. And if we look at the 9-month figures, those expenses have also increased year on year. It's kind of like trying to run faster while carrying more weight.
So, despite higher sales, they're spending more to achieve those sales. It's a classic case of diminishing returns, perhaps.
It could be. They might be investing in growth initiatives like expanding their EBO network or maybe facing higher raw material costs. The investor presentation mentions they're expanding their brand-focused EBOs, so that could be a factor.
Okay, so expanding their physical presence. The presentation mentions they've gone from 488 EBOs in March 2024 to 591 by December 2024. That's a significant jump. What about their different sales channels? How are they performing?
Well, the channel-wise performance shows that retail accounts for a larger percentage of sales in Q3 and 9 MFI25 compared to non-retail. Specifically, retail made up 53.3% of sales in 9 MFI25 compared to 46.7% from non-retail channels.
Interesting. So they're leaning more into their own stores and national chain stores. Does the presentation give us any insight into their product categories?
Yes, it does. It seems apparel units make up a significant chunk of their volume sales. Also, jeans, shirts, trousers, and t-shirts are their major product categories. There's also a sales realization analysis showing the average revenue per unit.
Got it. Now, let's talk about the balance sheet. What are some key takeaways there? Are there any potential red flags?
Well, their total assets have increased significantly from 837.2 crore rupees in March 2024 to 1,439.9 crore rupees in December 2024. This increase seems to be driven by growth in both current and non-current assets, including property, plant and equipment, and inventories.
Okay, that sounds like they're investing in their operations. But what about liabilities? Did those increase as well?
Yes, total liabilities also increased, mainly due to higher current liabilities like borrowings and trade payables. It's something to keep an eye on, but it's not necessarily alarming, especially if it's supporting growth.
Okay, good to know. Now, I always get a little nervous when I see debt increasing. Are they taking on too much leverage? This is just a reminder that, disclaimer, we advise investors to check with certified experts before taking any investment decisions?
Well, their debt has increased quite a bit. They went from relatively low borrowings of 2.5 crore rupees in March 2024 to 113.8 crore rupees in December 2024. That's a pretty big jump. We would need to dig deeper to understand why, possibly related to funding their expansion or acquisitions.
Okay, that's a significant change. Will be something to keep an eye on. So, considering all of this, what's your overall take on Kewal Kiran's performance?
Well, it's a bit of a mixed bag. Revenue growth is definitely a positive, showing they're still capturing market share. But the decline in profitability and the increase in debt are causes for concern, and require a closer look.
Yeah, it seems like they're in a transition phase, investing in growth, but also facing some cost pressures. So, what would be your recommendation to investors based on this report?
I would say proceed with caution. The company's expansion strategy and brand portfolio are promising, but investors should monitor their profitability and debt levels closely. It might be worth waiting for a few more quarters to see if they can improve their margins and manage their debt effectively.
Sounds reasonable. So, to sum it all up, Kewal Kiran is growing, but they need to focus on profitability and debt management to ensure sustainable long term success.
Exactly. It's like they're building a bigger house, but they need to make sure the foundation is strong enough to support it.
Right. Well, this has been a pretty insightful analysis. Before we wrap up, do you want to encourage our listeners to like, share, and subscribe to our YouTube channel for more in depth financial breakdowns?
Absolutely. Don't forget to hit that like button, share this with your friends, and subscribe so you don't miss out on any of our future content.
Great. Thanks for your insights.
My pleasure.